Hello, and welcome to eOption's webinar. And we're happy to have you here with us. And thank you for taking the time out of your day to join us. We're excited to partner again with Teddy Keckstadt, a professional trader with over 30 years of trading experience, to bring you this timely webinar on trading the 2020 election using ETFs and options. My name is Gina Bocayas, and I'm with eOption. And to provide some basic logistical information for today, the session will last approximately 1 hour, and if you have any questions during the webinar presentation, please feel free to type them into the question box, and our speaker will answer those at the end of his presentation. We encourage any and all questions, and please use the Q&A box at the bottom of your screen and not the chat box. If you put it in the chat box, our speaker may not see it, so please make sure you use the Q&A box. Also, you can reach out to eOption's experienced trade desk at any time if you have any additional questions after the webinar on trading strategies or any questions about options or using our platform. You can access the recording of the webinar in the next week on our website at eoption.com, and we will also be emailing each of you a copy of the recording who attend today. And for those of you just joining, we'd like to welcome you to our webinar on trading the 2020 election using ETFs and options. And as eOption's name implies, we are a brokerage firm that specializes in option and stock trading. We charge some of the lowest option rates in the industry. Options are just 10 cents a contract plus $1.99 per trade, and all stock and ETF trades are commission free. We also offer many tools to help you in your trading strategies, especially with options. We also support option education, and we're glad that you can join our webinar today to learn more about using options to trade in this volatile market environment. You'll also find more educational videos and past webinars on our website at eoption.com under resources. So I'd like to turn our attention to our speaker now, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption this year, and we're happy to welcome him back again. And just to tell you a little bit about him, he traded on the Chicago Board Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years, and he's been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked, and he is the author of a book called High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, for that introduction, and eOption for presenting this webinar today. And we're going to start right off by getting into a couple quick little things we have to take care of. So Gina already gave you a little background about me. So now we're going to put up the eOption disclaimer just as to take care of some things that we have to do for compliance, and just to let you know that this webinar is for educational purposes and informational purposes only. And if you need any more information about the disclaimers, you can check out the eoption.com website. And also for my company, since I'm doing this, I always put mine up as well, which I can spin through because this is a video. All right, so what we're going to talk about today is how to maximize your option trading potential. You can use options for stocks, ETFs, and other types of option trading strategies. You can use an eOption, which Gina had already given you a brief little introduction to, so we can skip over this. She talked about their ways of stock-free trading as well as cheap options pricing. So what you're going to learn today. So we're going to learn how to trade stock and other market movements without large capital allocations, for one, how to expand your portfolio diversification, how to maximize your potential returns with options, bear and bull directional strategies, as well as neutral strategies, and how eOption can help you improve your bottom line. Now, so we're going to use the 2020 election event, which is a spectacular thing to use when it comes for examples, especially for what we're going to talk about today. So for many of you, so there's many of you that are traders, some of you are just investors, and I'm sure that there are times when you've traded events before. The election obviously is always a big event in U.S. When it comes to the U.S. markets every 4 years. This year has been one crazy year for God knows everything else. So volatility, it definitely is something I think everyone knows and agrees will be here. So why stock option strategies? Well, the first thing is you can lower your cost basis. At eOption, it's only 10 cents a contract for options, which was explained to you. That helps to keep your cost basis at a minimum. Options can help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital as well as ETFs. Options allow you smaller to large investors the ability to capitalize on trending markets that are highly liquid, such as the ones that we're going to talk about today. And this is a very important cost control. The less your commission costs are, the more you will earn when you are profitable, and the less you lose when you are not profitable. So trading in these products is similar to trading in normal equities, but with a higher potential for ROI and controlled risk, which is a wonderful thing. Anytime you can control your risk as well as amplify your return on investment, you are doing the most you can do, as whether you're a trader or an investor. So today's focus, we're going to be talking about the 2020 U.S. elections with ETFs and options, which ones will be most likely going to be in play. We're going to show you bullish and bearish strategies. So just to remind you, this is not a political webinar. This is about what is going on currently in the market, what has happened, and what is most likely the consensus based off of whether or not you have a win on one side or the other. The good thing is that because of what the strategies we're going to talk about, we're going to have our defined risk, which is huge. Having defined risk for any trader or investor is always important. It's one of the key rules to success. Anyone that does not have that as a component in their trading or investing strategy, you are definitely bleeding somewhere. Now, simple execution is also something that is important, and we're going to discuss that too. And there's nothing that we are going to talk about today. There are many very advanced option strategies and equity plays that we are not going to get into any type of discussion about. These are very simple, easy spreads and outright positions that anyone can execute. So volatility, direction, and cost are the key variables that we will be covering today. Okay, expected impact on the markets. So the incumbent Trump, if he wins, stronger equities, reduction in safe haven investments, meaning like, for instance, because it's an election year and with the COVID-19, there's always safe haven, flight to quality type of investments. Sometimes it's the US dollar. A lot of times it's gold. A lot of times it's the 30-year bonds, and all these things influence equities and moves in equity sectors. So a Trump win would be bearish gold most likely. Stable interest rates. We know that because of Fed policy. It's stated that no matter what for the next year, they're going to keep rates at where they're at. They have no intention of raising them. So that's a variable that usually you don't have that much foresight from the Fed, but due to, and this is not political, these are economic conditions with what's going on in the world. That's probably why that variable will stay that way. Stronger trade policies, you know what's happened over the past 3 years. So to think that anything would be different if Trump remains the president for another term, and stronger U.S. dollar. So the dollar has been relatively stronger versus most currencies over the past 3.5 years, except for, obviously there's periods where it's a bear and it's a bull, but overall it's been stronger. A Biden win, what does that mean? Well, just like we can't predict who will be the president or necessarily what's going to happen with the markets, we know that a Biden win, odds are, is going to reverse a lot of economic things that were set over the past 3 years. Does that mean that all equities are going to go down? No, there's going to be lots of stocks that are going to be winners under a Biden win, and there's going to be lots of stocks that are losers under a Biden win. The same would happen if it was Trump that gets reelected. There's always bulls and there's always bears. It's not all going to go well for any sector. So we're going to get into these ones that are most likely to have volatility. So the good thing is you don't have to be right on who's going to be the president. You don't even have to be right on which sector, where it's going to go. Our strategies are going to help you to profit no matter which way they go. Now, also with Biden wins, equities are expected to stagnate or fail. Why would they do that? Well, because of projected lockdowns and more restricted regulations and other things like that. Will that happen? We don't know. That just seems to be the leaning consensus. Skyrocketing national debt, that's happening under no matter who wins. However, with the other social policies that are expected to be put in place, that would be on top of everything that's already going on with Corona and what have you. Higher taxes, that's been stated multiple times that that's the first thing he's going to do is raise taxes. So these are the things, the variables that we're going to look at, how this impacts certain sectors and how you can profit with options and ETFs. So let's get into which sectors that should do well. A Trump win: energy, defense, materials, financials, US dollar. These are the ones that have done well over the past 3 years. Obviously, defense, building up the military, there's most likely no chance he's going to fade on that if he still has another term. Materials, obviously building, infrastructure, these are things that are going to continue to grow. Financials, not that financials are safe, because we have a lot of issues with the credit markets and other things that can drag the economy. Banks are definitely not necessarily on stable ground, but they're more likely to have support under a Trump administration. US dollar, if the trend is your friend and it stays consistent with what has happened over the last 3 years, except for when there are bearish fundamentals involved, the US dollar should most likely remain strong. And now with Biden, utilities stand to win. Consumer staples stand to win. Alternative energy, solar companies, wind companies, you name it, all stand to have very good projections moving on into the future should Biden get the next term. Gold also, well, because of higher taxes, a relatively unstable forecast for the equity markets and other things, and increased COVID-19 response and how they seem to be looking at how they want to deal with things. Gold is obviously going to most likely be something that's going to continue to remain a bull. So how do we trade this and prepare our portfolios for this? The sectors that should do poorly are the ones you really want to pay attention to and protect yourself. So when our first option strategies are going to actually cover that. So if Trump wins, consumer staples are likely to get hit, and also alternative energy stocks, because just as if Biden wins, that those should do well. The opposite is for Trump. Now with Biden wins, pharmaceuticals, probably are going to be under pressure for a little bit. Consumer discretionary are going to be under issues. Energy companies like ExxonMobil, oil companies, we know that his stance on oil, what that is, and that stands to with oil as it is going into COVID-19 being under pressure, and then with the consensus that Biden wants to literally limit the oil industry over the next 10 years. These are issues that will weigh on those stocks. But the alternative energy stocks on the flip side are going to do very well. So, and then there's the US dollar, which is projected to go the opposite way as well. So strategies, November option expiration. Everything we talk about today are for options that expire into November, or you can even now, if you're going closer into, or if you put them on into next week, then you'll be looking into the December options. So we're right on the cusp, because you want to have options that expire somewhere between 30 and 45 days. So for equities, covered calls is a strategy that you want to look into. Collar trades is a strategy you want to look into. Outright long call and put trades are trades you want to look into. And then there's credit spreads. For ETFs, trade the sectors outright. You can do that. Straddles and strangles, option spreads are very good, which you could also do for stocks. Outright long call or puts on ETFs instead of trading the ETFs. And you can also use the ETFs and the ETF options as a hedge for your broad portfolio. Like for instance, let's say you have a lot of money vested in, say, mutual funds, where some are heavy in financials. You could hedge your mutual funds with an ETF trade or an ETF option trade. The same as if you're in a mutual fund that's heavy in pharmaceuticals or metals or what have you. And we're going to get into how you put these trades in. Now, real quick, for those of you that are not familiar with this strategy, a covered call is where you own the stock and you sell an out of the money call above the market, the strike price above the market of where the stock is trading at. A collar is where you would sell a covered call and you'd also buy a put. The covered call would be out of the money above the market from the stock price, and the put would be out of the money below the market from the stock price. Obviously, outright long call or put would be just buying the call or put either right at around at the money or near a strike price to trade the direction for the equity. Now, credit spreads are the same. They're a way of getting long or short, and that's where, for instance, let's say you're long whatever XYZ stock, and instead of doing just a covered call, and you'd want to make a little bit more money, and you actually are more bearish, that's where you would sell the out of the money call, like a covered call, right off the bat, and then you would buy the next higher strike price or two strike prices higher back, which would mean you would have a credit for that transaction. So you would be selling the nearer out of the money call and then buying the the further out of the money call, which would give you a credit for the transaction. And then your only risk would be the difference between those two strike prices minus the credit you take if the market was to go against you. Now for straddles and strangles, they're very similar. Straddles is where you buy the call and the put at the same strike price. And the strangle is where you buy the call just a little bit above or at the strike price of the stock. And then you have a put on the other side, which is just the next one lower. So there's a little bit of a gap for strangles. So straddles is the same strike price. Strangles is where you use two different ones. And then we have the outright, once again, position, which you can do for the ETFs. So now let's get into our first example. We have the XLP. Okay, now this is the consumer staples ETF. So now remember, this is not political. We just picked sides here on which one is most likely going to gain or lose by who would possibly become the next president. So when we did this webinar, this XLP was trading at 66.17. Okay, so now if you wanted to do an outright ETF strategy, you would be long this if you were bullish the consumer staples, and which, for instance, if you were bullish Biden, you'd be looking to continue to stay long XLP, or if you were long XLP, then you would already be looking just to have an option strategy on for the election, and vice versa for Trump. So what would you do here? So the nice thing about it is, it doesn't matter who you want for president, you can put on a neutral strategy, because the odds are going into this election, wherever we are trending, when we have things that are working for us for many of these strategies. Volatility is rising and is going to most likely continue to rise into November 3rd. So you can see I have November 3rd and it'll be marked on all these sides. This is where we're heading to. Now, when I did this slide over a week ago, this is where the market was at. It was at 66.17. Now today, the market's actually lower. It's at 62.71. So that puts it all the way down here below by this box right here. That's a big drop. So now what would have happened, regardless of whether you were bullish on Biden or Trump, you could have put a straddle or a strangle play on. So the market was trading at 66.17. So the closest strike price would be $66 even. So you could have put on a straddle at $66 for the call, or excuse me, a $66 strike price call and a $66 strike price put for the straddle, or you could have done a strangle. Now remember, the strangle is where you use two different strike prices. In this one, you could have had a 66 half call and a 66 even put. Now, when you look at this, the price of the strangle would have been a little bit less than the price of the straddle, because you're getting one option. It's further away from the strike price. Okay, and now as far as direction, you would want to have for election win bet, you would do something different. So for the straddle and the strangle, you don't care who wins or who loses. So right now, just if you would have put on this strategy when I made the slides for this webinar, the market's trading now at 62.71 down here. So no matter what, your straddle or strangle trade would both be winners in this case. Now, as far as your outright election win bet, if you were buying the put, you would have been doing well on that, because you would already have over $3 in the money on the put. And then if you bought the call, well, that one would be the only loser on this. So that's the nice thing is, like I said, this is not a political thing. We're not taking an outright position on who's going to win the election. I definitely am not. And even when it comes to trading the election, I wouldn't do the same either. You have the ability to, and even if you say that it's going to go one way or another because of one win or another, the market's going to most likely do what it's going to do. So these neutral strategies are very good. Once again, because of the fact that we have rising volatility, which most likely will continue into the election, and then it should start to drop a little bit. So the positions you put on when it comes to especially like credit spreads or any type of selling of options, you'll be selling into high volatility, and most likely that'll work for you going into the election. And also for buying spreads, because of the volatility and the odds of the market not staying exactly where it's at as we head into the election and then post-election, you are really looking at a good situation for movement. And that's why you trade events. You know, a lot of people say, when's a good time to get in and out of the market? Well, there's times not to get in, like right before a Fed announcement when you have no idea what's going on unless you're trading volatility. But directionally, and even when it comes to getting in and out for pricing, those are times when usually it's a good thing for most people to stay away because you can't fight the machines. But when it comes to something like this, it's a totally different story because you're trading an event with an outlook of something that's going to go on, you know, afterwards for a little bit of a trend. And when it comes to these sectors, remember, these things have been moving because of coronavirus and other reasons, whatever, trending either up or down. But once the election is over, this trade is over. So when you look at these sectors, how they've been moving and how they're reacting, odds are you're going to get a lot of really good movement coming into the next 2 weeks. So situations like this straddle, you're already, what is it, over $3 in the money, where the straddle and strangle would have been moving. So like I said, this would have the market down here around $62. And then the only loser would be the put. And remember, it doesn't matter whether it says Trump or Biden. It's just a matter of whether it's a call or a put that's making or losing money on that trade. So the spreads do really well for volatility in that situation. The outrights, well, remember, you're making a bet no matter what, always with an outright position. Okay, no questions on the chat. So let's move on to the XLU. This is the utility sector. Now, at the time of this slide, it was trading at 64.09, and now it's trading just slightly lower at 63.24. Now, utilities, I think, going into the election are going to be very, very neutral. And I think it's going to be most likely once we get through next Tuesday or Wednesday and have the results, you're going to really start to see a breakout. So right now, utilities are usually very conservative as well. And you can argue for both sides on this one, but it looks like for the most part that Biden has the edge when it comes to the utility companies. So now let's take a look at this. So for this trade, the market was trading at 64.09. So the straddle and strangle trades would be to buy the $64 call and buy the $64 put, or you would buy the $64.50 call and the $64 put. Now, you could also do outrights if you want to really take a stake on direction for these sectors, you know, especially if you think that these are really the ones to gain or lose. Remember, these are only from consensus, you know, anything can happen when it comes to the markets for sure. But your outright trades would be buying a put for Trump and buying a call for Biden when it comes to the utility sectors. Right now, they're very neutral going into the election, and I think you're probably going to see that, but I would bet dollars to donuts that come after November 3rd, we're going to see some sort of either correction to the downside or rally to the upside for this ETF sector. Okay, now let's move on to the next one. We have the XLE. We have the energy sector here. Now, this one was trading at $30.19 when I did this slide. Now it's trading down at $28.14. So it's actually trading way down over here. So this has had a nice little move over the past couple of weeks. Let's see, are these trades that we would make before the election, or would you use the strategy after the election? Absolutely. For this question for Denise, these are trades that I would put on going into the election, especially like if you are an ETF trader or you like to trade sectors. Now is a great time because this is an event trade. Usually after an event like this, you're not going to see a flat line market. You know, usually when you have something like that, it's an event when you had something that happened, such as like a hurricane or something like that, where you might have some sideways. But there is so much publicity going on about this election. I mean, we're not going to get into the political parts of it, but economically, and then when it comes to the market with certain sectors, there's a very big tug of war. So yes, right now would be a really good time to put on these volatility plays like straddles and strangles. As far as doing the outright directional plays, I would always say, unless you have a valid buy or sell signal, never take any trades such as that. I would never go just on trying to make a bet on the election, on who wins the election, you know. So, but these sectors usually, on a consensus basis, you can see where you can trade these. So yes, I would definitely say the straddles and strangles. Now, as far as the election win bets, if you want to go outright long or short on a position or even do a credit spread in that fashion, I would wait until November 4th. or November 5th. Once you know who has won the election and things start to stabilize, all the noise is out of the market, and then most likely some sort of trend, whether it's a corrective trend or a continuation of a major trend, is most likely to occur at that point, because we'll be through the election. Okay, so now that that question is answered, XLE, once again, this was at $30.19 when we did the webinar, and now it's down at $28.14. So the straddle and strangle plays, both of these would be moving in the money right now. So this, for instance, the straddle, which is the $30 call and $30 put that you would have put on at the time of this slide when it was made, would right now be up about, well, a little over almost $2 as far as where the movement was away from it. So with the increase in volatility, you would start to see an edge on that play. Needs a little bit more movement to really become a big profitable trade, but it's definitely moving in the right direction. And the same as with the strangle, where you would have bought the $30.50 call and the $30 put. And remember, as far as the election win bets, this would be one where odds are that if Trump wins, the $30 call would be a good buy, and then also a buy in the $30 put should Biden win. So as far as the ETF sector, so if you wanted to trade just the ETF sector and you didn't want to do the outright ETF, remember the options are a great way to go for a short run, especially when you're trying to trade an event or post-event. Okay, now let's look at the PBW. What is PBW? Well, PBW is the clean energy ETF. So this is the one that goes along with the Biden trade. So for this one, when we did the slide, the market was trading at 69.25, and now it's trading at 63 double, which is quite the slide. So actually, if you would have put on any of these options, straddles or strangles, they would have a nice little move right now. You're looking at over $6 move right now, which would have you trading down in this area right here, right above where it says straddle and strangle on this box right here. So at the point of the slide, the $70 call and the $70 put would have been one volatility play to put on, or the $70 call and the $69 put also would be another one. And then post-election, or even if you were looking to get ahead of the election, like I said, I personally wouldn't do it. If I was going to do anything as far as going outright on these trades, I would wait until the election's over, because trying to pick the president, let alone to be right on the market as well, it's a double-edged sword. You're trying to hit both plays, which I wouldn't suggest. That's why I like the volatility strangle and straddle plays, or you could do credit spreads. Like for instance, let's say for this one here for PBW, the market was trading at right around 69.28. So let's just say that you were really looking for Trump to win. So instead of selling the ETF or even buying the put, a less risky trade would be to do the credit spread above the market, where you would sell, for instance, the $71 call. Like, see how I've been putting these three lines here, because there's different ones you could use for your straddles. But let's say you want to put on a credit spread. Instead of selling the ETF, or even buying the put, what you would do is you would sell the $70 call, and then you would buy the $71 call. And then that way you would have a credit between those two options, and your only risk would be if the market rallied above those strike prices, in which case your loss would be the difference between those two strike prices, which would be $1 minus the credit you received on that. So it wouldn't be that, depending on the pricing, and since you would be selling into high volatility and buying into high volatility, it would pretty much be neutral. So you don't have to worry about volatility when you do a credit spread at all. That's completely neutral when it comes to that. So that would be another way that you could trade this ETF as well. Now let's go and take a look at, we have the IHE. Now the IHE was trading at 169.85 when I did the slide. Now it's at 161.10. So that's all the way below this box. So this thing, the pharmaceuticals, is definitely in play. And we know that healthcare this is a great thing about why event trading is fun. And you can use volatility plays. So let's say you're long the pharmaceutical ETF, and you really like the pharmaceutical ETF long term. I mean, who doesn't? We have an aging population, what have you, coronavirus, et cetera, et cetera. why wouldn't you think the pharmaceuticals would do well, right? So it doesn't matter what your take is on who wins the election. Let's say you're a bull. But short term with the election, you don't want to deal with the volatility. You know that between the new court justice that was just approved, and now they have a big vote on the Affordable Care Act and a whole bunch of other things. Not to mention, we're moving through this election. The pharmaceutical industry is up for grabs because nobody knows how the whole insurance industry, what kind of look and face it will have, not even just a month from now, let alone 3 months from now or 6 months from now. So even though you want to buy this, you're bullish to pharmaceuticals, you want to put on a straddle or a strangle. So that's where you would look right now, around the well, at the time, you would have been looking at the 170 call and the 170 put, and you would also been looking right around the 170 call and 169 put for the strangle. So these volatility plays would already be, 161, you're looking at below this box right here. Both of these volatility plays would be huge. In fact, at this point, with only a week before the election, odds are you would be rolling these spreads. You would already be getting out, either just taking profit on them, or you would be getting out of these and putting on new ones just because of where we're at in that kind of market movement. And then obviously we have the outright $170 call for the Trump win, which obviously would be a loser right now. And then the buying the 170 put, which would be a winner. Right now, if you would have done it back then, like I said, if you're going to trade the election win bet, wait until the election win is decided and then try and jump on those trends. Because especially, like, for instance, here's a trade for you. Let's say a lot of you have owned like a company like ExxonMobil or Northrop Grumman that's been in a bear market for the past few weeks. They're pricing in a Biden win. If Trump wins the election, there's a good chance that even if oil stays low, ExxonMobil will be in a very neutral to potential bullish posture over the next 6 months to a year. It's been beaten up really hard. ExxonMobil is the same thing. So these are post-election trades that you can take these sectors, and we're going to get into it with the other ones as we get into the oil thing. So you can either, if you trade the equity, you can look for those plays, or with this, the ETFs is even better because you can trade the sector. You don't have to hit the individual wins with the companies or losses, and you can still trade the options as well on this. So now let's go into our discretionary sector. So XLY. At the time of the slide, the market was trading at 152.85. Today, right before the webinar, was trading around 145.96. Now, obviously, the S&Ps and the broad stock market is down over the past week or so, which is definitely laying credence to why these markets are getting some kind of nice move to the downside. And for the most part, most markets are dragging right now. So it's not a Trump-Biden thing. It's not necessarily an election thing. It's just the market is selling off because of the coronavirus. That's why these sectors are what we're looking at, because even in the midst of a breaking stock market, some of these sectors are rallying. Just remember, whenever the market's going up or down, there's always a contrast somewhere else. There's always a bull market somewhere. There's always a bear market somewhere. So now the Select Spider Trust here, ETF. The 153 call and the 153 put would have been the one of the credit option strategies you would want to put on for volatility, and also the strangle, the 153 call and the 152.50 put as well. Now, the one nice thing about the consumer discretionary is that this ETF and this sector typically trends a lot. It's like you can usually count on currencies to trend. Consumer discretionary, it's rare when it holds a neutral sideways market. So going into the election right now, it's very, very likely that since it's already trading down here, it's already had a big move. It's had over a 10% move in the past week and a half. We're heading into the election. Odds are pretty good that we're not going to stay in a straight line going flat line across for the next week or two going after the election. So your straddles and strangles, if you had put it on then, you'd probably be looking to roll them just because of the fact that, let's just say you get a bounce back. Well, then your straddles and strangles are going to be pretty much worthless. You would have missed the trade. So, like I said, since you have the movement already going into this one, I would look to roll out of these and then you do, what did I say? The XLY is trading at 145 now. So you'd be looking right around the 144 to 146 options and trying to put on a new straddle or strangle if you wanted to do a volatility play in front of the election. And then obviously post-election would be, you'd be more bullish for Trump and bearish for Biden for this sector. In theory, as far as, like I said, the consensus is. But right now, because of the movement you've already had, it would be a situation where this straddle and strangle, now you would be rolling out of this. And think about this too. This was done back on the, what was it? It was back just a week and a half ago. If you have a 10 to 15% move in, say, a ETF such as this or an equity, and you have a volatility play where you're already in the money, where you've had an $8 move or so, something like that, that's a big deal. That's a time to always readjust and think about taking your profits. Okay, let's see. I believe you mentioned buying options 30 to 45 days out for the strategy. Why not buy them for a sooner date, just like a little after the election at a lower price? Okay, so we have a question from John here, two questions actually. Like I said at the beginning of this webinar, the 30 to 45 day out options are the ones we were looking at. These were the November elections when I first did the slides. Yes. Now, what you're talking about, a lot of people will do that when they have earnings and short-term short-term until option expiration. This is something that I would be very cautious with for most of you that are listening. You have to be very good with your timing and know your pricing if you're doing such a thing. Yes, you're right. That is a way that you can profit and have a very huge return on your investment if you were to trade the nearest option expirations. Here's the problem with that. I look at that situation is the same as buying out of the money options and doing for instance, let's say you're very bullish on a stock and it's trading at $50 and you're like, oh, I'm very bullish and they're going to come out with earnings and it's going to soar. And instead of buying the at the money calls, you're like, oh, I can see it going $25, $30 higher. So I'm going to buy the out of the money $20 calls, and buy like 100 of them. And then all I need is a $5 move above that to make, 10 times what you normally would make. Those situations just don't happen that often. The theory is there, but the ability to capitalize on them typically is not very strong. And you have to be right most of the time, because the few times that you're not, you're just feeding the fire. Like you need too many wins to recoup your losses to become a positive. So I hope that answers that question. The second half of the question is, how long after the election would you wait before taking positions on in the money options, taking profits on in the money options? Okay, so after the election, if let's say you put the straddle, like one of these straddles or strangles on right now in the consumer discretionary. Once you have, obviously the election is on the 3rd. Let's just assume that we know who's going to be the actual next president the next day and the votes are tallied properly. Like I said, we're not getting political here. Then I would say that your straddle and strangle plays, for instance, I would say you're going to have most likely a period of 1 to 3 weeks to really capitalize on it. Here's the main reason is that we're going into the election, obviously, post-election. Let's, like I said, say that hopefully on November 4th, we know the answer. Well, then people are going to start to reevaluate and start to reposition. Funds are going to reposition. All kinds of investors are going to be repositioning. Investors are going to be all lined up and chomping at the bit. So I would say you have 2 to 3 weeks. And that's why I like these further out options, because you have time for them to get the movement. Okay. So like, for instance, the mid-November to the December options, because now we're talking about if you were to put them on now or right after the election, that will give you the best bang for your buck as far as pricing, because here's the thing is that as you get like the shorter term options, like the first part of the question was, why wouldn't you use something that's expiring very quickly? You just need it to be around for the election. And then after that, and you can cash out. That does work when you're trading, especially earnings and certain events. With this one, there's too much noise, and especially because there is the possibility that we may not know on 4th what is the outcome. So those situations would not pan out. Now, however, once an actual decision is laid out, I think you're going to have every bit of 2 to 3 weeks to jump on it. Like, for instance, think about this. Let's just say that Trump wins. Let's just do it this way. Landslide victory for Trump or Biden. Okay, we're not getting political here, but just to make this as an easy, what would most likely happen? If Trump wins, you're going to assume that there's going to be more of the same policies that have been going on for the past 3 years. So even though it's the stock market is bearish because of coronavirus, it's less likely to fall as harshly because of it. Now, let's just say Biden wins by a landslide. Okay, well, coronavirus or not, the stock market's going to be very, very unhappy about the fact that they're going to like, okay, taxes are going up, which means that the stock market's going to be suppressed. There's going to be all kinds of selling because you're going to have only this year and then next year to take your capital gains at the lower tax rate. Because once Biden gets elected a year later, when everything's overturned, there's going to be, I mean, think about this. You'd rather sell your stocks now or sometime next year than a year later at a higher tax rate and possibly even at a lower market rate, so it's not going to be, so you're looking at volatility one way or another. And that's why I like these neutral trading strategies. Okay. And then also, like I said, for those of you that are invested with like mutual funds, like consumer discretionary, there's a lot of you that have mutual funds that are heavily weighted with consumer discretionary stocks. You're not going to do anything with your mutual fund, and your fund manager is in control of that. But what you can do is you can have a position on in an ETF, either long or short, or you can put on the options and also have some kind of a spread or a hedge against your mutual funds. So then, and the beautiful thing about the straddles and strangles is if your mutual funds go up, you make money, and your straddles and strangles will make you money. And if your mutual funds go down in the short run, your straddles and strangles will make you some money, and you'll have a little bit of a return while part of your investment is slumping, but you're still long that investment. So you still have time working with that one. So for when you have an equity position or a long ETF position, you can cover yourself with that and hedge yourself with that. Okay, now let's move on to something called the XLB. XLB is the material stock. So we're going to look at let's see, this will be elected when taking into consideration foreign policy. Okay, we'll get to a couple of those questions in just a second. I just got to breeze through a couple of these slides real quick, and then I promise I'll get to these questions. Thanks to you guys are asking a lot of questions today. That's great. So the XLB, which is the material stock, straddles and strangles. At the time of this webinar, 66.27 was the price. Now it's trading at 62.13. It's all the way down here. So once again, these sectors are in play going into the election. That's the beautiful thing about this is just because it's, let's say, for instance, you were trading this XLB before, or now you want to take a look at it. It's corrected from 66 down to 62 in just a matter of a week and a half. Let's say it continues to trade lower into the November 3rd election. It's either in the middle of a new bear trend, or it's ready for a corrective move higher again. So the odds are once it comes into this area where it's at, if you were to roll, like right now would be a very good time to roll out of a straddle and strangle that we would have put on before. So let's say that when the slide was going on, somebody put on a straddle or a strangle, which would be the 66 half call, the 66 half put, or the 66 half call and the 66 even put. Those right now would be winners. Now would be a time to roll out of those into another option, trading somewhere around the 62. So I would say probably the 62 even call and 62 even put, and then maybe the 62 half call and 66 even put for a strangle. If you were going to roll right now in front of the election, I would wait until after the election. Right now, it's Wednesday afternoon. You have a weekend in front of us, and you only have Monday and Tuesday's trade. It's going to be ridiculous. So there's going to be a lot of noise, and like I'm telling you, I would just wait until then if you're not already in, or price yourself in now and then get ready for the ride, because odds are pretty good that we're not going to have a sideways market a month from now. XLF. This is the financials. This is another one of the sectors that we had talked about. Now, as far as the financials here, this one was trading at around $25. So the $25 call and put would have been the straddle. The $25.50, which is this one here, and 25 even put would have been the strangle. Straddle options spread that you would have put on. And then obviously since then we've had what kind of a move? So XLF was trading at 24.94 and now it's trading at 23.66. So this one, the financials are very stable. And this is another reason why I think, you know, it doesn't matter who wins. We know most likely financials are favorable under one versus the other. This is looking like a sideways trade right now. So this is pretty much where it was when I did the slide. It's just moved over a couple days. And this is another one too, where I don't think that the financials are going to sit quiet once you got to remember, if you have a Biden win, financials are going to swing regardless. They're going to swing because they're faced with higher taxation, lockdowns on businesses and all kinds of other restrictions. And then on the other side, you still have the coronavirus issues and whatever, but you're going to have a less restrictive environment. So definitely a post-election straddle and strangle play is probably a good idea with the financial sector ETF. Especially if you already are long it, why not have a hedge on it? So then we have the XAR, the aerospace and defense. So aerospace and defense definitely looking to boom under a Trump election, and under Biden probably going to slump because you're looking at defense cuts right off the bat. That's something that was already on his table, is defense cuts. So that's the first place he's going to look for to find money, you know, as far as cutting spending. So for this one, for this ETF right now, it was trading at, what was it, 92.50, 92.56. Now it's at 85. Yeah, it's down here. So this market here, this ETF is pricing in already a Biden win. And this is a good one too. Like, let's say that Biden doesn't win the election. This would be an ETF to either look to get out like long to buy the ETF, or to definitely put on a new straddle or strangle. I mean, if you would have put on the straddle back then, it would have been a $93 call, $93 put, with a strangle of $93 call and a $92 put. Both of those now trading down at, what is it? Like I said, it's at the 85.57 area right here. So now would be a good time to put on a new straddle and strangle right around the $85 strike price. I've got a couple of questions I'm going to get to in just one more minute. I just want to go over two more ETFs real quick. We have the gold ETF. Remember, we talked about gold as a sector. This would be another one to look at. This one is pretty neutral. So where the slide is at right now, it's pretty much where the market is trading right now. Gold was at 178.30 for this ETF when I did the slide. Now it's at 176.5. So it's pretty much these same strike prices. I would look around this 179.5 to 179 area for your spreads. Gold is one that, like I said, wait until after the election, because it's been trending lower, pricing in a Biden win. If it's been trending over the past month, rather, trending higher, going against its longer term trend because it's pricing in a Biden win. A Trump win would most likely have gold selling off again, because gold has had such a good run. So anyone that is no longer looking for such a flight to quality and thinks that their stocks and other investments are going to stay relatively stable, then gold will probably not suffer, but just no longer be quite the bull that it was. Now, one thing you can also trade is the US dollar. I'm a currency trader. Most people are not, or futures traders. So one way you can definitely trade the dollar is with the UUP or the UDN. So I didn't put the options on this one because it's hard enough for people to know which direction it is. So basically it's like this. The UU up is when you are bullish the dollar. Okay, so if you're bullish the dollar, you would buy this ETF or the some sort of option play being bullish. If you were bearish, you would sell this ETF or put on an option strategy the same. Now, the one thing that you could also do is that you can do conversely, because just like there's an up, there's a UDN, which is a US dollar down. So if you're this is the thing is where if you think it's going down, you buy it, and if you think it's going up, you sell it. So it's inverse. So these are, if you want to trade the dollar on this, I just wanted to brush on it so you know that it's there. It's a little bit of a confusing thing for most people because of the inverse relationships. So I would not go outright on this one unless you're an educated, experienced investor and you understand the fundamentals with this one. But you could do neutral straddles and strangles on both of these, and they're basically the same. It doesn't matter which one you take if you're doing neutral strategies. All right, so I'm going to do one little quick plug and then answer a couple of questions. When you get a chance, if you like this presentation, you can check out my channel, Forex Trading Unlocked, on YouTube with all kinds of video content with different lessons. You also have the eOption webinars as well, just like they have on theirs. And you can check out highlights of the book, High Probable Japanese Candlestick Patterns, which I wrote, which is available on Amazon and Kindle in different versions. So you can check that out. And now let's get to our last couple of questions from the, let's see, we have taken into consideration the foreign policy of the U.S. presidents, diversification of emerging markets. Okay, foreign policy has nothing to do with any of the trades that we just were talking about here. Foreign policy does have an issue with certain things, but that has more to do when you're trying to figure out trade balances and things like that. So then you can go with a protectionist for America for Trump. That's where you would go with that if you want to get on that political end of foreign policy. And then also foreign policy being where things work in our neighbors or our allies and enemies' favor, then you would lean towards that sort of a slant. So let's see, that will be elected in one. Hope I am clear. Thank you kindly. How to trade the tech sector. Okay, the tech sector obviously is booming because of the coronavirus thing and everything else. That's a tough one, but here's what I do like. Yeah, cloud technology, data centers, things like that, because no matter what technology you go with, those things are going to be used. They're the core. So I would definitely lean towards those. The nice thing about data centers is, let's say you like to play the real estate markets. There's a lot of REITs out there. Most data center stocks are actually REITs. So you're actually trading the real estate market in a way that you're kind of covered because you have a guaranteed cash flow renting structure. That's a whole webinar another day. So, but you can look into a couple of them, like QTS is one of them. There's a couple other ones. Let's see. Are you allowing your losing straddle position to expire worthless, or can you cancel it by exiting the position? Yeah, straddle and strangle positions. If, for instance, the market, the only way it's losing is if the market goes sideways and it doesn't go anywhere. If that's the case, considering that you are buying into high volatility and there's no real consensus that volatility is going to drop anytime soon, as long as there's enough time in the spread, yeah, then I would say you could still get out of it as a loser if you think the market's going to continue to go sideways to recoup whatever you can from the trade. But especially if there's not much time left in the trade and volatility is still on the rise, then I would hang on to the position, because at that point, you got not very little to lose, and your risk reward on any type of move becomes huge, to where if the market explodes all of a sudden right before expiration and you get out of the trade, then you're looking at having, well, then you lost on the trade when you were right. And that's a situation that you have to weigh. Depends on how much is left in it. And I mean, if you're only going to get a couple dollars back for your, I mean, the good thing is it only costs you 10 cents to get in and out of an options contract. It used to cost you more. So, I mean, it costs you next to nothing to get in and out. So that's something you have to weigh. I would say that if you had still a month or a month and a half, and it was only 10 days into the trade, yeah, get out of it if you think it's not going to go anywhere and the volatility is dropping. But if you only have like 4 days left after you've had it on for 30 to 40 days, well, at that point, let it expire worthless and take the shot. At least that's what I would do at that point. And let's see, what scenarios make the strangle better or worse than the straddle? Here's where you make where a straddle or a strangle would be better versus the other. A straddle is a little bit more expensive, but is typically the one that you will, you'll be right more often because it's at the same strike price. When a strangle comes out into play where it's really good, this will be one of our last questions, is let's say that the market's trading at $50, okay? And you buy the $50 put and you buy the $50 call. Well, the $50 put, since it's at the money, that's going to be the more expensive option. And the $55 call, that's going to be less expensive. Now, had you bought the straddle, which is buying this $50 call and the $50 put, because they're right at the money, that's going to be a more expensive position. So it's going to cost you more to put it on. okay? And then the movement, as far as how far you got to go, is more on the straddle than it is on the strangle. So if you're right and the market goes down, okay, let's say you're bearish, okay, and you put it on. So this would be a situation where you're not necessarily just looking for a volatility play, you're bearish. Let's say you had a sell signal. So you would do that, you would put on the strangle instead of the straddle, okay, because you know that the call that you're buying, which is above the market, is going to be cheaper. And that's the one, you're not looking for the market to go up. You're looking for the market to go down. So because of that, you're gaining a little bit of an edge because you can, the position costs you a little bit less. But then you also need a different type of movement, for that to be profitable if it goes the other way, because then you need more of an upside. So your risk is that you better be bearish to neutral and not bullish, because if you're bullish, that kind of trade would screw you in that sense. So that's where you have to layer your straddle differently than your strangle versus your straddle. So if you're bearish, you would have the call be the further away option from the strike price. And if you were bullish, conversely, you would have the put as the further level. So now we are at our 1 hour mark. I think I've answered all the questions. Just want to remind you guys once again, you can maximize your option trading potential at eOption for your stock, ETF, and ETF options trading. Free option strategy tools like Options Play are available on the eOption.com website. The free option strategy guidebook is also available on the website, and free paper trading account to test your strategies is available. ETF and stock trades are commission free always. And remember, option contract commissions are only 10 cents. And I want to thank you very much once again for your time. And remember to like the eOption.com on Facebook to get advance notice of future webinars, latest market views, and investing tips. And also check out forex-trading-unlock.com if you want to see me again sometime. Also, thanks a lot.
Great. Thank you so much, Teddy. That was very interesting and informative. And thank you to our audience for attending and for the excellent questions and feedback that we got on the Q&A section. It should be an interesting week for the markets, and also the significant volatility in the next week. I'm sure all of you saw the significant volatility today and downward pressure on the markets. And we hope that our speaker gave you strategies no matter what the outcome is for the election and how to play volatility. And eOption hopes that we can be your partner in option education and trading. And just to reiterate, we have much more education on our website for options trading. If you go to eOption.com and go under resources, you'll find so much information on there. You'll find our past webinars, trading videos, and we also have something we're very excited about. There's clickable links provided by the Option Industry Council. So if you have a question about a strategy, let's say you want to trade an iron condor, you can click on it and it'll tell you all about the strategy, when to use it. A lot of them have short videos, so it's an excellent resource. I can't stress it enough. And we also have free option trading tools like Options Play, as Teddy mentioned, where it scans thousands of stocks every day and helps you set up an options trade to fit your needs. So that's also a tremendous resource. And that's normally $500 a year, but that is free for all eOption customers. And if we're all over social media as well. If you like us on Facebook, you will get advance notice of future webinars. We do try to do 1 to 2 a month. You also get the latest market news and investing tips, and we carefully curate that to make sure the tips are relevant and interesting to our audience. And as mentioned at the beginning of the presentation, we will have this a video recording available later this week, and you can find it as well at eOption.com under resources, under webinars and videos. And as a courtesy to everyone attending, you will also get a copy of the webinar, and we will email that to you directly. And again, don't forget to take advantage of our low rates. All stocks and ETFs are 0 commission, and options are just 10 cents a contract plus $1.99 a trade. So if you want to try any of Teddy's strategies, the savings, you can get a tremendous savings on your commissions compared to many other players out there. And so again, just to reiterate in closing, we hope that this webinar gave you some good ideas on how to play volatility in the current election. And thank you so much for attending, and be safe. Thank you.